Hello, everybody. Today is the very important, probably by far one of the most important lessons for you to understand. It's about the margins. Margin calls, what is the margin? Why the broker will liquidate your positions? Why most of the people don't know how to calculate the right amount of shares or whatever any positions you can take. So today, slowly we're going to talk about how to properly calculate the positions, how to avoid margin calls. So in the beginning, before we go any further, the most important thing is to understand what is the margin call. So for example, let's say you trade Forex. The average margin on Forex is 100 to 1. So for example, if you have $1,000, you can trade $100,000. Same as in the futures. Let's say if you trade S&P intraday, and let's say you have $1,000 of your personal money, you can trade with $100,000 positions. So the exchange broker actually give you the margin, and the brokers control how much money you need to have in order to calculate your risk and in order to have a positions. So let's say you trade oil, right? Let's say you need, if you trade with the interactive brokers, you need approximately $1,000 to trade one contract of oil. The one contract of oil will run you at about $100,000, so, but you need only $1,000, so it's 100 to 1. So figure out the issue. The issue is very simple. If you lose 1%, let's say the oil price right now is $90, so if you lose $1, which is a 1%, you're going to lose the whole money that you have. And now I'm going to try to explain, because most of the time people don't understand how to calculate the numbers and everything else. So I'm going to open the paint right now, and I'm going to try to understand and explain for you how it works. So figure out one thing. Let's say we have the oil. As I said, the oil right now is about $90. The money that you need only $1,000 to trade one contract of oil. It's an intraday margin. It's called intraday margin. If you decided to hold a position overnight, obviously you're going to need a completely different money. But let's say S&P 500, you need only, let's say, $500 to $700 to do one contract of S&P. It's a very easy to check, and we're going to try right now to check so you'll understand. So it's not numbers from nowhere. So it will go on Google help, intraday margin for SP 500 futures. So let's say you go on the Ninja Trading. Let's say right here, you see Ninja Trading. You need $500 intraday margin. That's what it is. It says right here the interactive brokers charge you $8,800, which is incorrect. Yes, it's not an intraday margin. It's not available on all accounts. That's not correct. The interactive brokers charge you somewhere between the $500 to $1,000. So that's, you see, the Ninja Trade interactive brokers intraday margin. So right here, over 22 hours per day, you can trade with the $500. So the commission's also very low. See, the platform is very good. I know Ninja Trading for a long time. So what do we have here? Let's say it's the S&P, and let's say we go right now intraday margin for the oil. So oil futures. It's a trade station, but you can go in any other. Right here, you see S&P E-mini, $1,200 intraday maintenance, $1,120. So let's say mini Dow Jones, micro, blah 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 blah. Eurex, it's Forex, currencies. No, we're not interested. Interest rate, no. metals, no energy. Okay, so you see the trade station takes, roughly $3,500, and let's say how much Ninja takes. So I want you to understand. So before you go any further, you will understand what is the margin. Too much information. But as far as I remember, Ninja takes about $1,000, $1,000 intraday margin. Okay, let's see here. Okay, right here, view margins. So you'll understand exchange, blah, 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 blah. Okay, Forex, we're not interesting. Okay, crude oil, $1,000. You see? So this is a $1,000 right here, crude oil. And this is $1,000. You see? This is the intraday margin. For a lot of futures, you see, let's say E-mini euro, you only need $250. So that's what it is. This is the margin that you need. Now, I will show you that if you're going to do something wrong, you're going to get killed. This is a very important thing. And after that, we're going to learn how to calculate the position. This is very important. So right now, figure out the oil, as I said, you see I put it correctly, it's about $1,000. So now you have to understand where you're going to get killed. Okay, so figure out the oil is right now $90 per barrel. You have only $1,000 account, and you have a margin of $1,000. The average stop for the oil is about 10 cents. So what does it mean? If you lose 10 cents, you lose 10% from your margin. But if you're going to lose $1 from the oil price, you're going to lose 100% of the money. Why? Because the $1 represents loss of $1,000. So when you incorrectly calculate the number of the position that you need, that's the issue you're going to have. So obviously you're going to have a margin call, and you're going to have very fast, even before you lose $1,000, probably somewhere when it's going to be $700, you're going to have a maintenance call. Maintenance call is when the broker basically tries to protect not your money, but his money, making sure that you're not going to go lower, because if you're going to see a very large move, let's say to the downside, you can lose money too fast. So the very important thing that you need to understand, you need to calculate the right position. And that's what we're going to talk about right now, how to calculate the right position. Honestly, it's very, very simple. So there's two things you need to know for sure before you calculate the positions. Either you work for the percent. So this is stop loss over the percentage from the deposit, or you can have a fixed loss amount. So what does it mean? Let's say in the first scenario, right, your maximum risk per loss per trade, it can be either the percent of your deposit, let's say 1%, 2%, 3%, 0.5%, or a lot of people, they have a fixed loss amount per position. When I begin to trade 25 years ago, I had a certain fixed amount of dollars. Since my deposit was not that big and the firm was providing me with the capital, I had a number of a fixed loss. So that was the number that I was feel comfortable to lose. So very important thing again, it's to understand. So let's say we have $10,000 deposit, right? $10,000 deposit. And let's say our stop loss is $50. Doesn't matter, 0.5%, 1%. Usually when you actively trade, 0.5% from the deposits for the stop loss, it's perfectly fine. So this is the fixed amount of risk that you take. It comes from here. Remember, very important thing. Once you're gonna take the fixed stop loss, you're gonna have no issues with your trading. I guarantee you. It does not really matter. So the biggest problem to avoid margin calls, maintenance calls, let's say unusual losses or anything else, come to the certain point. You have to have a fixed loss. So our fixed loss, let's say it's $50. Figure out we trade stocks, right? So let's say, very simple. Let's say our stop loss per stock is 20 cents. 20 cents. So it's a 0.2. This is a stop loss on a stock. This is a stop loss per trade, per stock in dollars. And this is, let's say, you buy any stock and you put a stop loss 20 cents. So it's very easy. You have to take $50, split over 0.2, and you can take 250 shares. So if you're gonna take 250 shares and you're gonna lose 0.2, so 20 cents, your stop loss is gonna be only $50. Let's go one more time to calculate, and I'll show you. Let's say you have an account of $1,000. Obviously, you cannot intraday with $1,000, but let's say you have $1,000, and let's say you're just a beginner and your stop loss is $20. So it's not only stop loss, this is a maximum you are allowed to lose per trade. So this is your maximum amount of losing per trade. Let's say you trade cheap stocks and your stop loss is 10 cents. So 10 cents. So you have to take $20 divided by 0.1, so 10 cents, and your maximum position you can take is 200 shares. So now figure out one thing. Once your stop loss going higher, you take smaller position, or once your stop loss is going lower, you take the higher position. But this number always stay at the fixed price. This is a very, very important thing you should understand. So you have a $20, it's a maximum loss. Let's say you're a big guy, right? And your account is $100,000. 101, 2. Okay, you have an account of $100,000. And let's say you stop loss $500. You see, this number always has to be calculated towards your account. So you should understand that this number, it's fixed. Trust me, you know, I've been in trading for 25 years. It's very easy to figure out. You can go and check my CRD when I got the license and everything else. Among most of the people which saying, you know, I was in Goldman Sachs, I was in Morgan Stanley. I had an offer from Stephen Cohen many years ago in 2006, and I refused. So you should understand one thing. I know exactly what I'm doing. And the only reason why I survive in trading, just because I calculate the risk. I always take from the risk side. Remember one thing, if every single trade that you're going to do is going to come from the risk side, you'll have no issue. So let's say our risk is $500. Let's say we trade Tesla, right? The Tesla stop loss usually is $1. So you take 500 over $1, and this is the maximum position, 500 shares you can take by Tesla. I guarantee you, usually in our industry you cannot say the word guarantee, but I guarantee you one thing. If you're going to trade against the stop losses, if you're going to put the right stop losses, if you're going to calculate the position the way I tell you, you never will have any margin calls. When can you have a margin calls? First of all, if you take big account, you take position overnight, and let's say the stock is going to go against you, then you can really have issues. But if you trade intraday, you'll never have issues. So what do? In order basically to stay alive, you have to split the number of risk against the positions that you have. So for example, if your risk per day, $100, right? Split over, let's say 3 or 5 different positions. So your risk is going to be between $30 to $20 per position. and that's how I calculate. I learned one thing for a fact, and I'll tell you something. When I began trading, my boss told me one very important thing. He said, Alex, I could never control how much money you're going to make, but I'm definitely going to control how much money you can lose. This is very important thing. So my advice to any of you, if you want to, and it's exactly the same for the futures, it's exactly the same for stocks, for cryptocurrency, or anything else. If you want to avoid margin calls, maintenance calls, when you lose all the position, trade towards the stop loss per position, per day, per trade. So for example, that's usually what I've done before. Let's say my stop loss per day was $150. I can split over the 3 trades, so my maximum stop loss is going to be $50, or I can split over the 5 position and my maximum loss is going to be $30. So I go not towards the stop losses, but from the stop loss. What is my stop loss? So what position I can take? This is the most important thing. I come from here, so this is the maximum I can lose. Remember one very important thing. When you have a certain amount of dollars in your pocket, this is the maximum amount of dollars that you have. So for example, let's say you go to McDonald's and you have a $30. There is a certain amount of food you can buy. Let's say you can buy 7 Happy Meals, or you can buy 7 burgers, or you can buy 7 cheeseburger, or you can buy, let's say, 5 coffees or anything else. But remember one thing, the risk per trade, this is the maximum amount of dollars you have in your pocket. It's a maximum you can spend. And if you're gonna go from the maximum amount you can spend, I guarantee you, you're never gonna lose money. Why? Because you come from risk. Remember another thing. For example, let's say you build in a restaurant and you put a certain amount of dollars that you calculate. And let's say you have $100,000. And then, let's say, God forbid, something happened and you need another $20,000. You're in trouble. Why? Because you have to go and borrow $20,000. So you're above the budget. That's the most important thing. When you trade, you have to have a budget. You have to have a budget to trade. You have to have a budget per stop loss. And remember one thing, I don't know what anybody's going to tell you, 3 easy steps to invest, 5 easy steps to make money. If you are not going to trade your position from stop loss, you can say goodbye to your trading. I only trade for 25 years, only. It's a funny joke, just because I always trade towards the risk. For me, the most important thing is risk per trade, risk per position, risk per day, the maximum number of position I can take, the maximum number of stop losses I can take, and then I go weekly, monthly, and everything else. And if something goes wrong, let's say I lose 3 days in a row and I lose more than I can, I stop trading. So before you go into a real life with the trading, my advice to you, very simple. Calculate everything, go against the losses. The most important thing for the trading and for the traders, it's for you to have tomorrow. Most traders don't have tomorrow because they are basically not following just a very simple rules. You can learn charts, you can learn entry points and everything else, but if you're not going to have a risk management, money management, control of the position, control of the risk per trade, stop losses and everything else, I'm telling you right away, you can finish your career even before you start. So good luck to you. In order to avoid margin call, the rule only one. Make sure you have a maximum dollar you can lose per trade, per day, per week, per month, and then you're not going to have any issues with the margin calls. Good luck to you.